Hello and welcome, everyone. Definitely excited to have each and every one of you here. Thank you so much for joining us today. The presentation that we're going to hear is on taxes. This is great information for all of us small business owners. We've got Scott Transue here with us today. And a little bit about Scott, just to share with you. He does do speaking on sales and tax use, accounting for non-accountants, accounts receivable and payable. He also does presentations on income tax planning and personal finance. Now, Scott has a business where he provides representation with the IRS, working to manage all of that. And then he also does QuickBooks training. I'm going to turn this presentation over to Scott. He is going to take questions at the end. Many of you have submitted your questions ahead of time, and so Scott is aware of that and has those. So Scott, please go ahead and take over on the presentation, and welcome. Thank you so much for being here today.
Kathy, it is a true honor. Thank you so much for the opportunity. Hello, everyone. As Kathy said, my name is Scott Transue. I am an enrolled agent with the IRS. Now, just as a little bit of a background on me, I started in this industry about 4.5 years ago. I was a preparer for Liberty Tax Service. If any of you have ever driven down the street and seen those really funny people with the Liberty costumes on waving at you, well, that's us. That's Liberty Tax. And in about 4 years' time, I've done over 500 individual returns. That includes everything from Sole-Proprietor, which is Schedule C, through partnership reporting, some S-corporation stuff, and so on and so forth. The enrolled agent licensure that Kathy alluded to, that is a license granted by the IRS that is obviously federal. I have unlimited representation rights in all 50 states, including Hawaii and Alaska, obviously. And it's really for any taxpayers, whether they're individual or a business, who are experiencing any kind of issue with the IRS, whether it be not having filed, owing back taxes, being in collection, whatever the case might be. And really my job is to intercede on your behalf with the IRS and try to find the best resolution possible for the situation that you are in. Now, this is all about taxes in small business. I am going to touch on the Affordable Care Act towards the end of the webinar, because there are some important things that you need to know about that are coming into effect as of New Year's Day 2015. But let's talk about, first of all, the types of business entities that small businesses tend to enter into, let's say. The most popular one is the sole proprietor, which on a federal income tax form would be the Schedule C. Most small businesses that are one person that are providing a service like babysitting or let's say housekeeping, stuff like that, would choose the sole proprietorship. It is the easiest to form because there really is nothing to form. You simply claim your business on your taxes. You don't have to deal with any state regulatory body, so to speak. The big issue with the sole proprietorship is you have unlimited liability. If someone sues you, they're suing you in your name. Your assets are at risk, all of that stuff. So you have unlimited liability. It's easiest to form. You do have to pay self-employment tax, which is the equivalent of the Fica taxes that you would pay as a W-2 employee. You are allowed to deduct half of those on the 1040 itself. So you do get a a break there. It's essentially the employer aspect of the FICA taxes that you're allowed to deduct. So the sole proprietorship is the easiest. The next one up would be a partnership, which is Schedule E within IRS speak. And most of the time, this is done by a professional services firm like a law firm or a CPA firm. And the reason they do it is because many times the partners have, on an individual basis, very specific expertise in one area. As an example, if it's a law firm, they may have an attorney who does nothing but bankruptcy law. They may have an attorney who does nothing but divorce law. They may have somebody who does nothing but personal injury. So the partners are gathering together as one firm and then essentially farming out the cases to each partner based on who is best able to represent that particular client, okay? There is unlimited liability for partnership debts. Proportional share of income is taxable whether it's distributed or not. Now what this means is income from the partnership has to be reported on your 1040 as your individual return, whether or not the partnership actually distributes the income. It's rare that a partnership would not distribute the income, but it's a possibility. Whether they do or they don't, you are still, it is still considered taxable income to you as a partner. Now, there is a partnership tax return that's required. It's 1065, that's the form number, which may or may not be of use to any of you moving forward. And it's really an informational return. It's not something where you're filling out a form and sending in a check or getting a refund. It's mainly to track what's called partnership basis. In other words, you entered the partnership giving cash or property or something, most likely, and it's meant to track increase or decrease in your basis based primarily on how much the partnership earns, or if there's a loss, hopefully there isn't, but if there is, that would reduce your basis because you would have a proportional share of the loss that you can claim. Now, the limited liability company, the LLC, it's a fairly new form of organization, and it tends to be very state-specific in terms of how it's organized. Okay. In my case, I just set one up for my speaking business, and it's a hybrid of a partnership and a corporation. The LLC, some states will allow what's called a one-person LLC, which really, in a sense, makes it a sole proprietorship without the unlimited liability. Your liability is shielded by the corporate veil. In other words, if you get sued, the person suing is actually suing the LLC and not you as a person. Okay? So you have the right to elect other you have the right to elect other types of taxation for this. You can elect to be taxed as a partnership. You can elect to be taxed as a corporation. If you are in a state where you have or where you are allowed to be a one-person LLC, for all intents and purposes, it's like being a sole proprietor without the unlimited liability. Okay. If you are in a state that does not allow one-person LLCs, then you either need to find somebody else to come on board with you and simply do it as an LLC or pick another entity. Okay. Now, moving forward, we're going to talk about two different kinds of corporations here, and they are quite different in their tax treatment, and they're quite different legally as well. I am not an attorney, so I'm not giving any kind of legal advice here, I will tell you about the tax ramifications. An S corporation, most people have kind of heard of. It's based on subchapter S of the IRS code. It is a separate legal entity, which means that you do have to register it with your particular state, just like you would have to with an LLC. The income is passed through to the 1040 directly, okay? So it's whatever the income is that the S corporation earns, it is passed through to each particular shareholder, as it would be with a partnership. It is limited to 100 shareholders or less. Now, this is important in the sense, and we'll touch on this again a little bit later on, if you are married and you have you're in an S corporation, you are treated as one shareholder if you are married and filing a joint return, okay? There does sometimes come an issue where married couples get a divorce, and there is a ramification with that with an S corporation that we'll talk about later. Just understand that it's limited to 100 shareholders or less, and we'll get into why people do subchapter S's, but for right now, just understand that. C corporations you are familiar with. They, any company on the stock exchange, the New York Stock Exchange, Microsoft, 3M, the other ones are all C corporations. They are separate legal entities. Big difference here is that income is taxed at the corporate level, and it is also taxed at the shareholder level when it is distributed as a dividend. Okay, if the corporation pays a dividend, it is taxable to each shareholder. So there's, we call it double taxation in the tax world. Just understand that in an S corporation, there is no double taxation. And in an S corporation, you're limited to 100 shareholders or less. Let's get into why you would elect each one of these, the specific reasons. Sole proprietorship, you elect a sole proprietorship because it's really the simplest one to declare. You don't have to do anything but say you're a sole proprietor. You are allowed losses for the first 2 years. The third year, if you don't show a profit, the IRS does have the right to question you, and they can reclassify your sole proprietorship as a hobby, which you don't want to have happen, okay? But you are allowed losses for the first 2 years you are in operation. The third year, because the IRS is assuming there is a profit motive there, the third year you should be showing at least a minimal profit, or the IRS can start questioning whether or not this is actually a business or it's simply a hobby that you are choosing to call a business, okay? Partnership, as I said before, it's specialized knowledge of a pool of multiple members getting together for a percentage share of the profits. They each contribute capital, which can be cash, or it could be cash and or property. For instance, somebody might contribute furniture, they might contribute a computer system, could be anything that would relate to the partnership. Some partners simply write a check to the partnership to get it going, and that's their basis, okay? The LLC, liability protection, definitely, and or shield assets under the corporate veil. As I said earlier on, if you get into some sort of lawsuit, they are suing the LLC. They are not suing you as an individual, which means that they can only recover the assets that are shielded by the LLC, okay? Now, when LLCs first began, they were very popular with real estate investors. What would happen is real estate investors would essentially, when they were buying a property, they would go to their state license or state board that regulates LLCs, and they would put the address of the property as an LLC. In other words, 123 Main Street LLC, which the goal there was to shield the deal for them. In other words, nobody could come in and do a competing bid or do something like that, okay? Now it's being used by a lot of people, not only individual professionals like myself, but also, and maybe more importantly, professionals who have a fiduciary responsibility. In other words, they are managing money, they are doing something on behalf of somebody else where there is a duty of care, all right? There are examples of this, such as somebody who is a Social Security disability attorney who is operating on their own. They're not part of a partnership. Many times they will set up an LLC because there is a fiduciary responsibility. If they make an error on the case and the person loses and there is a lawsuit filed, they're suing the LLC, they're not suing the individual person. So sole proprietorship, it's just you or you and your spouse. Loss is allowed for first 2 years. Partnership is a specialized knowledge pool of multiple members who get a percentage share of the profits. LLC is essentially, if your state allows it, a sole proprietorship with limited liability, and you're also shielding assets. If you're in a state that doesn't allow one-person LLCs, you need to find somebody else to join you. That's all that is really that matters there. Where I live in New York, they allow one-person LLC, so it's very simple. As I said, I set one up for my speaking business this past week, and it took all of about a half an hour to do. It's not a big deal to put them together. S corporations, we talked about no double taxation. The main reason people go this route is, let's say it's a family company, and they want to keep it closely held. They will typically elect S corporation treatment because they know there's going to be 100 shareholders or less. It's a family. And also, if they're looking to raise a little bit of capital, but not, a large amount where they would be doing a public offering or something like that. They're looking to raise some capital, possibly, and issue stock. But they want to keep it closely held. Most common example is a family corporation or a family business that incorporates. The C corporation, main reason for this is because of the double taxation rules, which I'll show you an example of in a few minutes. If you are looking to raise a lot of money to expand a company or to just get started, let's say you're looking to raise millions of dollars, that's going to be tough to do just as an S corporation. You are probably going to wind up forming a C corporation with your state and doing an offering of stock, and you're looking to raise money for something that's capital intensive. Maybe you need to start a factory. Maybe you need to do something that requires a lot of equipment, a lot of furniture, a lot of more expensive kinds of assets to get moving or to expand. So in that case, a C corporation might be beneficial for you. Just understand the double taxation rules, and I'll show you an example of that in a minute here. Okay. Now, the big question that comes up always is, okay, Scott, which structure do I elect? And I hate to say it this way, but as the bullet point, the first bullet point shows, it really depends on your purpose for being in business, okay? The two factors that you need to consider are taxation of profits versus liability protection, okay? Is one more important than the other for you, okay? If you are not somebody who wants double taxation, then you don't want a C corporation. You want something else, okay? If you're somebody who's looking to raise a lot of money for something that is capital intensive and you understand the double taxation aspects, then a C corporation might be the way you want to go. It would be the way you want to go if you want to raise a lot of money. If you want to shield yourself against liability and shield your assets, you're looking at probably an LLC, which again is not hard to form. Just double check with your state about one-person LLCs if you're one person. If it's more than one person, it's usually not an issue. And also, as you can see the gentleman at the bottom of the screen looking at a pile of paperwork, the record-keeping requirements go up exponentially as you go from a sole proprietorship to a partnership, LLC, to a corporation. There's more and more paperwork and more regulatory filings that you need to do as you move up the ladder, okay? Sole proprietorship is very simple. You just claim it in your tax return. LLC or partnership, a little bit more record keeping, and usually there's what's called a biennial filing for an LLC, which means every 2 years. That could vary by state, so check with your state about that. And corporations need to file board of directors meetings, and most of the time they need to file quarterly statements, okay, and stuff like that. So the record keeping and the tax filings go up exponentially depending on the form that the business form that you elect. So just understand that. Okay, now I mentioned before about an S corporation and the 100 shareholder rule. There is something called a forced C corporation. And this is a technical term. I don't want to, get too far into this because it's something that happens very rarely, but it is a possibility. If you have shareholders in an S corporation who are married, they are considered one shareholder if they're a married couple. If they divorce and they remain shareholders in that corporation, they now become two shareholders because they're no longer married. If an S corporation exceeds 100 shareholders, the IRS will do what's called an involuntary conversion to a C corporation. In other words, even if it's 101 shareholders, well, that's more than 100, so you are now no longer an S corporation, you're now a C corporation, which means you are now subject to taxation at the corporate level as well as taxation at the individual shareholder level. So you have that double taxation factor kicking in. All right, so just understand that that's a possibility if you elect S corporation status. It does not happen very often, but that's when somebody like me as an enrolled agent might get a call and say, hey, wait a minute, I just got a letter that we are now a C corporation. How did this happen? I don't know what this means. And usually it's because of there's a divorce among the shareholders, and now you're above 100 shareholders. All right. The other question is, do you want to maintain the right to change structure down the line? Okay. Obviously, sole proprietorship can become a partnership. You find somebody who wants to partner with you and it makes sense for you to do it, you set up a partnership or you set up an LLC. If you're somebody who is a sole proprietor and you want to raise money for your business, you can certainly elect S corporation status. You can simply file for an S corporation and take care of it that way. Now, some conversions are allowed, some of them are not. The most popular one that is disallowed, for reasons that I just mentioned, is a a C corporation can never elect subchapter S treatment if there's more than 100 shareholders. If you've got more than 100 shareholders, you're a C corporation, period. You cannot elect subchapter S, just the way it is. So just understand that. But pretty much any other conversion is fine as long as you do the required filings with your particular state. Okay, now this is not as clear as I would hope that it would have been on the slide, but I wanted to give you an accounting version of the difference in cash to you between a C corporation and an S corporation. This is kind of the tax structure. The C corporation, you'll see net earnings before corporate tax, because remember, a C corporation is taxed at both the corporate and the individual shareholder level. 35% is what you see there. That's not a firm percentage. It could be more, it could be less. I just put 35% in because that tends to be the average, okay? So you see your net earnings of $1 million, corporate tax to the IRS of $350,000, net income to the corporation of $650,000. You elect to give all $650,000 to your shareholders as a dividend. You have a very nice board of directors, and you want to spread the wealth around. Personal income tax on the dividends is 15% on average. So that leaves after-tax cash to the shareholders of about, I'm just going to round it to $550,000. Okay? Now, as an S corporation, you don't have the double taxation. So the $1 million of net earnings is given to the shareholders as a dividend. 35%, probably, maybe less, maybe very rarely is more, because I believe right now 35% is the top for dividends from S corporations as a tax rate for individuals. But you'll see there that after-tax cash to shareholders in an S corporation is $650,000. So essentially, by electing S corporation status, as long as you are at 100 shareholders or less, you are saving the shareholders about $100,000 in taxes. Okay? Which would you rather pay, 35% corporate or simply the individual dividend rate to the shareholders? At the C corporation level, you're going to pay, as the screen shows there, possibly as much as 50% in taxes, and that's federal only. We're not even talking about state. And at the S corporation level, you're paying the 35% only. So you're saving quite a bit of money there. And again, there are reasons why C corporations make sense. I'm not saying that they never make sense. Just understand that there is a much bigger tax fight as a C corporation than there would be as an S corporation. All right, now I call this the Deductible Dozen. These are the most popular deductions taken by small business owners, whether they're sole proprietorships or LLCs or partnerships or whatever. Home office, obviously, if you are a sole proprietor or a one-person LLC, you probably have a home office, which you can deduct the cost of. Office supplies, if you have an office someplace else other than your home, you can deduct the rent as well on that. The office supplies, the furniture, the equipment, software, computers, subscriptions to various magazines that are related to your business, or subscriptions to online services that are related to the business, mileage, travel, meals up to 50% because you have to eat anyway. And the IRS says, since you have to eat anyway, we're only going to allow 50% of your meals to be deducted. Entertainment and gifts, there are rules about that as well that are available through the IRS. I don't want to get too much into that because it does get a little bit technical, I want to keep this a little bit more general. Insurance premiums, retirement contributions. Now, I listed one here specifically, a type of IRA, individual retirement account, because not a lot of people understand the advantages of this. It's called a SEP IRA. Again, I'm not a lawyer. I am not a certified financial planner, so this is just informational for you. Look it up to see if it meets your needs or not. SEP means Simplified Employee Pension. Now, what this means for you is if you're a small business, even if you're a one-person LLC or a sole proprietorship, you can set up a SEP IRA with any brokerage house. And the advantage to you is that your net income, you can contribute to your own IRA as the owner of the sole proprietorship or as the owner, one-person LLC. 25% of your net income up to around $50,000 a year. Now, most IRAs that you've heard of, the contribution limits are a lot lower than that, okay? This is a special kind of IRA that is available to small business owners where you can contribute a lot more than traditional IRAs because you have a small business and the government it's really the government's way of rewarding you if in fact you go ahead and hire people. It's not them just being nice to you. It's them rewarding you if you hire people. You don't have to hire people to take this. You can do it on your own without having any employees other than, of course, you as the owner. But you are allowed to contribute up to 25% of net income, and that can be as high as $50,000. So that's a pretty good chunk of money to put away if you're a small business owner and you want to do it that way. Fica taxes, if you have employees, and also your own, of course. Office telephone, cell phone, that gets a little touchy because most people use a cell phone for personal use too. But if you could prove that the cell phone is purely for business and the bill is coming in your business name, the whole thing is probably deductible. If it's coming in your personal name, it's probably only half deductible because you're using it for personal reasons. Wages, obviously. I put child labor in there because there's rules about that as well that you'll want to verify with the IRS. The bottom one here is the one that as a preparer and as an enrolled agent I see missed more often than I care to admit to. Depreciation on your office equipment, okay? Now that could mean vehicles that you're using, that could mean your computers, that could mean your office equipment, anything that has a useful life of more than 1 year, okay? Now, it's very valuable because depreciation is an expense of your business, but you're not shelling out cash for it. It's a non-cash expense, which for some people is kind of hard to grasp. Just understand that it's a tax term, and you can claim it on your taxes. There's schedules that the IRS has that determine, how much did you pay for it, and then divide it by what the IRS would consider its useful life. And you can take that expense off of your net income. It's non-cash, so you're not shelling out any cash. So what you're really doing is you're reducing net income, thereby reducing taxes on your net income, but you're not shelling out any cash to do it, okay? It is really a gift. It really is. Now, there is something called a Section 179 deduction. What this means is, for the year 2014, if you go out and buy up to and including $25,000 worth of business equipment for your business, obviously, you can elect to either do the depreciation over the useful life of the equipment, or you can claim the Section 179 deduction and claim the entire amount you paid in the year 2014 up to and including $25,000. Now, if you have net income of at least $25,000 after all of those other expenses I mentioned above are accounted for, it may make sense for you to do it because it would bring your net income to zero, which would mean you would pay no taxes. If you don't have the income to justify doing 179, or you simply want to spread out the expense over a number of years, then you're of course free to do that. But the Section 179 deduction is there for you if it makes sense to do it, and it allows you to write off the entire cost of anything with a useful life of more than 1 year. Usually 5 years is what they tab it at for things like computers, office equipment, that kind of stuff. So just be aware that that's available to you as well. Okay, now, the Affordable Care Act. I intentionally kept this completely non-political because this is a hot-button topic and there's just as many people who agree with it as disagree with it. And this is a tax seminar, not a seminar on the politics of the act. The mandates begin in the 2015 filing season, and that is for 2014 taxes. The shared responsibility payment, okay? This is political speak for what's really a tax. And it's imposed on individuals who don't have health insurance and who don't qualify for an exemption from the act, okay? Just understand that it's tax on people who don't have health insurance, chose not to get health insurance somehow, and on their, when they go and file their taxes, starting January 2nd or whenever it is next year, there will be a line on the 1040 for that purpose. Okay, it's called a shared responsibility payment. It's really a tax, but they want it called shared responsibility payment. Now, the shared responsibility payment is 1% of household income above the filing threshold. And what I mean by filing threshold is your standard deduction or your itemized deductions plus the personal exemptions you claim on your tax return, okay? So it's 1% of household income above the filing threshold or $95, whichever is more. Now, there was a lot of discussion about this, that it was only $95 when the act was passed. Oh, you know, the penalty or the tax is only going to be $95. That may or may not be true, depending on household income, because it is based on 1% of it. But the maximum tax or the maximum payment, I'll keep it, you know, the way they want it discussed, is $285 per return. That is going to grow exponentially in future years, okay? Now, there is a codicil in here that a lot of people don't know about. If you're a taxpayer who claims at least $255,000 of income on their return, the penalty or the tax is not based on the return as it is otherwise. If you look above where it says maximum tax is $285 per return, that is true as long as your taxable income is below $255,000. If it's $255,000 or more, the penalty or the tax is based on the number of dependents you are claiming, okay? So if you're married with 2 kids, it's you, your spouse, and the 2 children. And for 2014, excuse me, it's $204 per dependent. So now we're getting into some serious money, okay? and this assumes that they remained uninsured for all of 2014. Okay, just understand that if your taxable income is greater than at least $255,000, the per return tax does not apply. It's a per dependent tax. Okay, and you can get more information on that from the IRS website as well. Now, the IRS has been tasked with the authority to enforce the shared responsibility payment, okay? Now, if you remember when the Supreme Court upheld the act as constitutional, one thing that they also did was they inhibited the IRS's ability to enforce the payment of the tax. Now, on your tax return, you may have to claim, if you're not insured, a particular amount of shared responsibility payment. Very important for you to know this, the second bullet point. The IRS under law, and this is in the Act, you can look it up, they cannot levy against property, and they cannot garnish your wages to recover any past due shared responsibility payment. The only thing they are allowed to do is offset a current year refund and any future tax refunds to recoup shared responsibility payments that you have not paid. All right? They cannot levy against your property, and they cannot garnish your wages. That is right in the Act. You can look it up yourself. A lot of people don't know this, which is why there's a lot of fear going around as of January 1st. Oh my gosh, I have to pay this extra tax, which you may have to do, but the IRS does not have the authority under the Supreme Court decision to come after property or to start garnishing your wages to recover the payment. All right. All they can really do is offset refunds. That is very important to understand, okay? And a lot of people still do not realize that. Now, if you want to stop any potential IRS action, which is to say stop them from offsetting tax refunds, you can show proof that you qualify for an exemption from the individual mandate. Now, I put a table here of the different exemptions. Some of them are quite complicated, and I don't want to get into all of them because they only apply to a very small percentage of people. The most common exemption that is there is that your premium for individual or family health insurance, if you're covering your spouse and kids, is greater than 8% of your household income, even if you're trying to obtain it within the state and federal exchanges that you've heard so much about. If the premium is greater than 8% of your household income, you can file what's called an unaffordability exemption on your taxes. Basically what it means is that you staple, or you, hopefully all the tax software that is out there will have this capability. But needless to say, if you're filing the 1040 and you can attach a piece of paper to the return showing that, wait a minute, the lowest plan available for me would still cost me more than 8% of my household income. Therefore, I can claim a hardship or what's called an unaffordability exemption. And you send that into the IRS and basically wait for them to send you a letter saying, yes, we agree with you, you are exempt from the mandate, and that is done on an annual basis. So obviously if a year comes by where the premium is affordable to you, meaning it's less than 8% of your income, then you need to deal with it. If you get a letter saying, no, we don't agree with you, the premium is something that you can afford, and we're denying the exemption request, that's when you would call somebody like me. and we would see what the situation is. Okay. The other exemptions, you're going to see on the second line there, short coverage gap. For 2014, if you had a coverage gap in health insurance of 3 months or less, meaning, let's just make it easy and say you waited until April to get covered, and you were covered from April all the way through the end of December. They would consider 3 months or less to be a short coverage gap, and you would just provide documentation to that effect, and the IRS would hopefully, because they would need to say this, yes, you are exempt because you had a short coverage gap this year. Now, the other ones down there, obviously, the second one from the bottom would not apply to any of you. It's incarceration. If you're in prison, obviously, you're not going to be mandated to pay a tax on not having health insurance because you're incarcerated. But that wouldn't apply to any of you. All right, now small businesses with less than 50 employees, which constitutes, I would imagine, a great number of you, maybe not all of you, but a great number of you. If you're a small business with less than 50 employees, you are not required to offer health insurance to your employees under the Act, okay? So small businesses with less than 50 employees, you do not have to offer health insurance to your employees, okay? If you elect to do it, it must provide what's called minimum essential coverage as defined within the Affordable Care Act. And you'll see that little graphic that says essential health benefits. It lists what the government is considering minimum essential coverage. It's really what within the federal and state exchanges, what the low level, what's called the bronze plan would provide for. And it's really what any company health plan typically would provide in the first place. Ambulatory, emergency room, hospitalization, all the way down, prescription drug, rehab services, laboratory services, all that stuff. So if you're a small business with less than 50 employees and you do elect to offer insurance, you have to make sure that the plan that you're offering offers all of those benefits. And usually what small businesses will do is they will contact their state exchange, which you can find online. If you just type in, let's say I'm in New York, I would type in New York State Health Exchange. If you're in Florida, you would, or the states that have exchanges, you would just type in your state and put health exchange in there. There would be a number for you to call to find out which companies offer plans that conform to the minimum essential coverage mandates under the Act. So the best thing to do would be to call the particular exchange and get that information from them. Okay. Now, if you don't elect to offer your employees coverage, they have every right in the world to simply purchase insurance through the exchanges, and that's something that you can recommend that they do. Okay. Again, if you don't choose to offer coverage, if you are a small business with under 50 employees, you don't have to offer coverage. You can simply tell your employees to find a plan within either the state exchange, if your state offers one, or through the federal exchange, which is available to anybody. Okay. Now here's the little carrot that they are dangling in front of you. If you do choose to offer insurance and you're under 50 employees. If you offer insurance to your employees, the federal government will offer you a tax credit to offset some of the cost. And the credit is equal to 50% of the premiums if you are a business with less than 26 employees, so 25, from anywhere from 1 to 25, okay? the credit would be 50% of the premiums that you pay to provide coverage. And you can decide, what percentage of the premium you're electing to cover. You can say 80-20, 90-10, 50-50, whatever you want to do. In other words, you'll cover 90%, the employee covers 10%. You'll cover 60%, the employee will cover 40%, okay? But whatever it is that you are paying towards their coverage, you will get some degree of tax credit. If you're a business of 25 employees or less, that credit is 50% of the premium that you're paying. So they are dangling a carrot in front of you to offer coverage to your employees if you are a small business with less than 50 workers. All right. Now, if you're a small business with 50-plus employees, you must offer health insurance to all of your employees, okay? And the penalty for not doing so, or they call it the penalty for noncompliance, is $2,000 per employee. And this is among the weirdest parts of the Affordable Care Act. That starts with employee number 31. Starts with employee number 31. So you're not paying a penalty for noncompliance on the first 30 employees. Why that is, I have no idea. It's just in the law. So from employee 31 to however many employees you have, there is a penalty for noncompliance of $2,000 per employee. All right, and that's if you have 50-plus employees. Now, just as a for instance, I'm not saying any of you should do this. I'm not saying it's a great idea. I'm saying that some businesses have elected this. The way out of this, if you will, and again, I'm not an attorney, but from what the research I've done and the work I've done in this area tells me that the way around this is simply to drop to 49 employees. All right. Again, that would bring up a host of other implications that you may not want. But if you're not at 50-plus employees, then you're not obligated to offer health insurance. So there you go. Now, here's the other thing that some businesses have done, and this was all over the news for a while. The mandate for 50-plus employees, if you're a small business, to offer health insurance if you have 50-plus employees, it only applies to employees averaging 30-plus hours a week. So for a while, there was this group of people that were called the 29ers. And the reason they were called the 29ers was because there were a lot of businesses, small businesses I should say, that said, well, wait a minute, if I'm obligated to pay for health insurance for all employees averaging 30-plus hours a week, that means anybody averaging 29 hours a week or less, I'm not obligated to offer health insurance to. So what happened was some small businesses, and again, I'm not recommending it, I'm not saying it's a great idea, I'm simply saying that it's out there. Some small businesses decided to make a bunch of their employees basically part-timers. They brought them down to 29 hours a week or less to get around the mandate. And they became known as the 29 hours, or the 29ers, I should say. And you see that big blue thing that says part-time. So that's something else to be aware of. Okay. Resources. Just so you know, I do not get any kind of royalty or compensation from anything. I certainly don't get it from the IRS. I'm offering these as resources for you to use because I think they're good. The first one you'll see there is a book by Nolo, which is a a very large publisher of small business, tax guidance, all kinds of legal guidance on various things. There's a book called Tax Savvy for Small Business. If you want it, go on Amazon. I'm sure you can get it quite inexpensively. If you have a Kindle, you might even be able to download it. I'm not sure. I did not check before I came on here. But that is a book that would go into a lot of what I talked about. I'm not sure how updated it is for the Affordable Care Act provisions, but I do know that it's a good book for the typical small business and wanting to save on taxes as much as you can. Intuit is the creator of the Quickbooks software program that many of you probably use or many of you might be thinking of using. Okay. You'll see their Certified Pro Advisor. I am in the final stages of getting certified for that. That will be done by the end of this month. Certified Pro Advisor means that I can help a small business do everything from set up a QuickBooks program for their business all the way up to using the QuickBooks data to put together their tax return for them at the end of the year. Okay. Now, there's two different versions of QuickBooks. One is the software that you load onto your computer. The other one is the QuickBooks Online version. Some people call it the cloud-based version. And that is a version that is, all of the data is stored by Intuit on their mainframe. In other words, you don't store the data on your hard drive. It's stored at Intuit's headquarters on their mainframe. Some people think that that's a better thing to do for security reasons. I don't have an opinion one way or the other. You can either buy QuickBooks and install it on your own computer, or you can use the online version. And I don't have an opinion on either way, whatever way makes sense for you. And of course, believe it or not, the IRS is a good resource. They have an entire small business division. If you go to irs.gov, click on small business in the search bar, there's an entire small business section that tells you about different types of entities that we've talked about, filing requirements, all of that good stuff. So the IRS really is a good resource. My motto is make them your friend rather than your enemy, because they are far better to you as your friend. So those are the three major resources that are available that I personally would recommend. And again, I get no compensation, I get no royalty for it, so this really is stuff that I believe in. I'm not just doing it for compensation or anything else like that. Now, Intuit is doing a set of day-long seminars regarding implications of the Affordable Care Act for the 2015 filing season, which would mean the 2014 tax return. These are sponsored by Intuit. You may attend whether you use QuickBooks or not, okay? They are, as far as I am aware, free seminars. I have not been told otherwise. There is one on November 4th in Dallas, Texas. I don't know the name of the hotel, unfortunately. One on November 6th in Houston, and one on November 13th in Los Angeles, which we're still waiting on enrollment figures to come in to make sure that Intuit plans to actually run it. But if, in fact, they do run it, and you are in the LA area or feel like flying to LA for an Intuit seminar on this whole thing, I am the one presenting, so you'll get to meet me, which might be an awesome thing. You can shake my hand and get to know me, and I can get to know you, and so on and so forth. They are looking at a New York City seminar that is way up in the air for logistical reasons. They don't have a date, they don't have a hotel, but it is an option that they are considering. So they have, I guess you could say, the Midwest covered and probably the West Coast covered. Nothing on the East Coast as of yet, but that hopefully will change by scheduling something in New York City. Now, my contact information is at the bottom there, okay? You'll see my Gmail address. That is my personal cell phone. I'm giving that out to you as attendees of this webinar. Feel free to call me if you have any questions, if you want me to go over something more in-depthly, if anything and everything that you wish to know about taxes and so forth, and small business taxes and so forth. If you want to use me as a resource, we can certainly talk about that. But definitely, that's my cell phone. I live in upstate New York. I can help you no matter where you are, even if it's a QuickBooks question. Okay, but either email me at that address. Feel free to call me or text me. If you text me, make sure that in your text you say, as an example, my name is Bob. I was on Kathy Liska's webinar with you, so I know who you are. Okay, and I want to be able to make sure it's personalized. And my LinkedIn profile is there. Actually, if you just type in Scott Transue, there's not too many of us on LinkedIn. If you look for the one that lists contract speaker trainer with national seminars, that's me. I'm wearing a white shirt and so forth. That is my profile. Feel free to send me a connection request, and in the box, so that LinkedIn doesn't question you, put in Scott, I was on the webinar that Kathy Liska sponsored, or something like that. I was on Kathy Liska's webinar. Something so I know, who you are. That way, I know to accept it, and everything is all good in LinkedIn land. Okay, so you have 3 different ways of contacting me. You can use all 3 or a combination of the 3. Doesn't bother me either way. I want to be a resource to you. Beginning in November, I am going to be on the seminar circuit 2 weeks a month. I do sales tax, I do debt collection, and I do a seminar on dynamic presentation skills, which I'm sure shocks the heck out of all of you. The difference is, I hear somebody laughing. I'm guessing that's Kathy.
Yes.
The difference with that is you get to see me live, and you get to see how I do a live seminar versus a webinar. And live seminars are different because they're live, and I get to walk around and be goofy and tell goofy jokes and stuff like that. So,
awesome. Hey, Scott, I'm going to jump in. I want to let you know you've got a ton of people saying thank you. They had to run because they scheduled their hour. I have a question for you with all of those that are here. There are a lot of questions that were submitted ahead of time and that came in. I'd like to invite you to join the Center for Coaching Certification group on LinkedIn, and then you can post some of these questions there. So I'll copy in. What I'll do is take the different questions, and where they're similar, that kind of thing, I'll just make it one question and get it up on LinkedIn, and then invite you to respond to people there. That will give everyone that's on the call a chance to connect with you that way. Plus, it'll have some people that weren't here today that are looking for how to do that. It'll get them involved as well. Is that enough?
That is perfectly fine with me. If you have time and if the attendees have time, I'm very happy to field a couple right now, or if you want to wait and hold off, that's fine with me too.
Let me give you, so given our audience, there's a couple that seem to be pretty common with everyone. So most of the people on our call are service providers. And they're asking about sales tax, as you mentioned your expertise there. So they're saying, okay, do I have to charge sales tax? Do I do it based on where the client lives, where I live? How does this work?
Okay. It's actually very simple. There is no federal sales tax, okay? So that's a good thing. There has been talk about a federal internet tax because of so much e-commerce being done. But there is, I don't know that it will ever happen. But let me get to the question itself. Sales tax only comes into play if you are selling your services to a consumer within your own state and your state has a state sales tax. It's that simple, okay? If you are selling, something to somebody let's say I live in New York, I'm selling something to somebody in Florida, since the customer isn't in New York State, I don't need to charge sales tax.
Okay.
Okay.
And is that true on the services as well, or is a service different than a product? Because I think some of them have both.
In my experience, and I'm going to put a little codicil on here because state sales tax, there's 50 different states, so there's 50 different sales tax systems out there, okay?
Mm-hmm.
Their best option is to go onto their state website, their whatever the tax department happens to be within their particular state, and type in out-of-state consumer and see if there is a requirement that they charge sales tax to anybody that they sell their goods or services to that live out of that state. I'm not going to give a blanket answer because there's 50 different states and they are all different. I mean, Alaska could be different than North Carolina. North Carolina could be different than New Mexico, okay? As far as I am aware, and again, check with your state tax department, product that is shipped out of state to a consumer, sales tax does not apply.
Okay.
Services may be a different story because services by nature can cross state lines, okay? Like if you're an attorney or you're you're doing some sort of, I'm trying to think of a service that you might offer somebody out of state, but there's probably
coaching.
What is it?
Coaching.
Coaching.
Yes.
Coaching. Yes. Well, here's a question for you, Kathy. Are you required to in your state to charge sales tax on to your coaching clients where you live?
Well,
if they live out of
yeah. This is the big question everyone's asking, and I'm like, Scott, I'm going to say I'm not an attorney, I'm not a tax advisor.
Very good, very good.
Any of that. So that's the reason we're all looking for that expertise. Okay. I apologize. We are going to have to close this out because of time constraints and scheduling. Definitely looking forward to engaging with you on LinkedIn and looking forward to having you back. There is a tremendous amount of interest, a lot of appreciation being expressed in the question panel. So thank you so much for being here, Scott. This was awesome, and we will look forward to hearing from you again and to hearing answers in LinkedIn.
All righty, and I will reiterate in 2 seconds. Feel free to contact me in any one or all 3 ways I mentioned. I'm here for your attendees. And have a great weekend, and I will talk to you all again.
Thank you so much.
You take care. Bye-bye now.
Bye-bye.